Hi and welcome to a new episode of Hedging with me. How are you? So today it's time to speak about a new tool for hedging, which is the call. Okay, we have seen already selling futures, we have seen already buying a put, we have seen already buying futures, and now it's time to analyze buying a call. What is a call? A call is the right to buy. It's a right, it's the right to buy. So again, what makes the difference between buying directly or acquiring the right to buy? I mean, there is a subtle difference because when you buy, let's say that the aluminum is 2,600, that will be the price for your hedge. Okay, so you buy in the futures market at 2,600, that's the price of your hedge. But if instead of doing that, you buy a call, which is the right to buy, you have in this call what we call a strike price, which is the price at which you have the right to buy. And in this case, again, 2,600. So on the one hand, one alternative is to buy futures. Let's forget it. The second alternative is to buy a call for which you buy or pay a premium, and a strike price, which is the level of your right, is 2,600. Okay. So why would I buy a call and pay a premium instead of buying a future where there's no premium? Is because buying a call gives you the possibility to exercise it or to abandon it. Okay? And let's suppose that you pay a premium of $80 for a call for next month. You pay $80 premium, okay, which is huge. It's a high value, okay? That works as an insurance against the price rise. So in other words, if the price goes to 2,700, you exercise the right, you don't have any risk, okay? So you are always protected. It's the insurance, it's like the car insurance against any accident. The accident in this case would be that the prices go up, okay? So why would you take all the effort of paying this premium? And listen very well, the logic is not the same as the logic of a speculator. It's the opposite one. You just buy the call as an insurance, okay? And when you buy an insurance, you don't want to crash your car. It's just in case you crash your car. And when you buy a call, it's just in case the prices go up, yeah? And in this example, you are paying a premium. So when you are a hedger and you look for protection and you use options, you don't want them to exercise. It's just in case. So the question will be, why would I buy a call paying a premium instead of buying a future when there is no cost? It's because I expect the prices to go down more than the premium I had paid. Yeah, and if that is the case, that the prices go down to 2,520 on this example, I will abandon the call and buy futures then when the market goes up, and I will get all the benefit of the market coming down. But this is not an easy decision. At least I want you to understand the logics and the mechanic. Why it's not an easy decision? Because you need to have a view on the market. The moment you decide to pay a premium, of $80 instead of buying futures as a hedge, paying nothing, you are sacrificing of your profitability $80. And you would only do that if your view, if the prices will go down more than $80, you will abandon the call, of course, and you will replace the abandoned call by a future established at a value lower than your break-even, which is the strike price 2,600 minus $80, okay? And that will be all the logic of the call for a hedger. Let's recap a little bit of the logic of a speculator. The speculator has no risk, and the speculator, in this example, he wants to go long, to buy. He has two alternatives: buying, boom, no cost, and buying a call, $80 cost, okay? But the speculator has no risk. He's creating the risk. That would imply that if he buys a call paying $80 premium, he needs the market to go higher than 2,680. And why would he pay a premium instead of buying a future when there's no cost? Because if he's completely wrong on the decision, his loss will be limited to the $80 paid for the premium. It's complicated, but I strongly, I would recommend you to see this video once and once again, because I'm going to bring an example with numbers during our next encounter. See you.